Well, hi guys, welcome to this Moneycontrol live stream. I am Nandita Khemka. Well, the two-day MPC meeting is underway and the decision will be announced by the RBI governor tomorrow. But a lot has changed since the last policy that was in June. We've seen the latest US data in terms of the job market that has come out. There have been cracks in the jobs market and there are concerns of a recession in the US economy as well. So how will the RBI really respond? We can't really say that the RBI will stick to the script. Will there be a change in language? Will there be a change in stance? What should one really expect against the backdrop of a very volatile global situation? Well, to put that into perspective and tell us what to really expect from the RBI this time around, we are joined by Latha, Venkatesh, Executive Editor of CNBC TV 18, as always, to take us through what to really expect. Great to have you on the show as always, Latha ma'am. As I was saying, a lot has changed. We can't really say that the RBI will really stick to the script, although there may not be any tinkering with rates. But how are you expecting the RBI to take note of the volatility that we have seen in the global economy?
Well, there are four things that markets look forward in terms of, hard numbers. One is the rate action. The other is the stance, which at the moment is withdrawal of accommodation. Third is the growth forecast, and fourth is the inflation forecast. Or maybe I should say inflation forecast, third, and fourth growth forecast. None of the four are expected to change. There is no question of a rate cut at this juncture, when the last inflation number was 5.08 and the Reserve Bank's goal is 4%. There's no question. In fact, the last inflation number was a little higher than expected because of a near 29% rise in vegetable prices. On stance, there is, although everyone expects that it will remain the same, or most people expect it will remain the same, there are a set of people who believe that it is time the Reserve Bank, there is no question of a hike. So why are we sticking to withdrawal of accommodation?
Right.
Why don't we say neutral, which means you can also hike, but the chances are that the hike season is over. So a neutral policy should be something the RBI should go to. Two members in the external members in the previous policy also had voted for a neutral stance. So we have to wait and see whether they do anything at all about stance in terms of preparing you for a change in the next policy.
Right.
That is the maximum you can expect. Again, growth, the US recession is feared. If the US definitely is slowing, how will that slow the global economy, and how will the third round impact be on India? It's too early to reduce the growth forecast based on that.
Right.
So all four remain unchanged.
Okay, all four remain unchanged. But before we talk about the internals as to what RBI will do with inflation, growth forecast, etc., just want to ask you: is it a little too premature to talk about US recession? I think you just said that we may be a little too early, but in terms of data points, it's just the labor market that has shown some bit of crack. But GDP figures have been strong. Inflation is somewhat cooling. Core inflation has cooled, right? Moving towards the target as well. Is there a case for an out of cycle cut by the Fed? Is there a case of that? Because initially, in June, we were working with a 25 bips rate cut perhaps in September. But now, of course, we're talking about 100 or, excess of 100 basis point cut this year itself. So, is there an out of cycle rate cut by Fed on the table?
Well, I want to say two things from the collective wisdom I have got. I'm not the resident expert on either the US economy or the Fed, but the collective wisdom that we have got is that there was an exacerbation of the reaction to the non-farm payroll numbers of July. It came in at 114,000 compared to 175,000 expectation, and the previous month of about, I think, 230,000 or thereabouts. It was a steep fall, 100,000 fall. But the reaction was still outsized because it was preceded by a rate hike by the Bank of Japan. So that made the whole reaction, it was the combination of the two and not reaction to the non-farm payroll per se. And the non-farm payroll as well was bad because of temporary layoffs. 70% of the layoffs were temporary. So the expectation of some of the experts I spoke to is, they may be brought back when things improve. So it may not be as bad for the month of August.
Okay.
Now much will depend on how the August numbers are. If it is a second month of bad numbers, then it becomes nearly a trend. In the past, we have had 175,000 and the next number 300,000. It's happened in the past. So 1 month will not make a trend. What has spooked the market is the unemployment number of 4.3%.
Right.
Because there is something which we newly learned called the SAM rule,
Right.
which says that, when the 3-month average of unemployment number, which will be 4.3, 4.14, so the average is 4.13. If that is 50 basis more than the 12-month low, now the 12-month low is 3.5, so it is 50 basis
is 50,
more.
yeah.
Then it invariably, apparently, always has pointed to recession. But here again, people say this unemployment number is exaggerated because of the temporary layoffs. So not everyone is buying this number. I think an intermeeting is practically ruled out. That was just the moment. Now everybody will watch out for what Jerome Powell says at the Jackson Hole meeting, which comes on August 28.
Right.
That's as good as a Fed policy day. Yeah. So, he's likely to say something very important over there. What is it in it? What is it in it for us in all this? I don't think the Reserve Bank needs to be, change its stance now at all. If the September rate cut is a 50 bips rate cut, then perhaps in October, the Reserve Bank can start signaling something.
Okay.
But this time, the maximum dovishness, I hope, is that there will be no hawkishness.
Okay, that's the maximum dovishness you're expecting. So you're not expecting any kind of indication that, okay, next policy, perhaps we can change the stance, even if we didn't do it this time around.
That is also an expectation. Okay, I would say that that's a slightly more daring expectation, but it is not off the table. We have to see there are still some inflation numbers and all expected. Right. So I doubt they will prepare the market for the change in stance, but it is possible that they will point out to extreme a scenario of global slowdown. They may just point to that scenario.
Sure. Let's talk about domestic factors then. Inflation once again above 5% for last month. Food inflation has been extremely sticky. We know that. But then there are forecasts of an above normal monsoon as well. In light of that, do you think the RBI will tinker with the inflation forecast? Because for the second quarter at least, will it need to adjust it a bit? And overall, would they make any changes? Or would they just adjust it around and keep the 4.5% intact?
That's what experts say. People who follow it minute by minute and follow the tomato prices and the potato prices. The expectation is tomato prices have cooled in many parts of the country, not in all parts of the country. And therefore, 4.5 for the current year will not be tinkered with. What may happen could be intra-quarter, increase it a little in the immediate quarter, decrease it more in the last quarter or something like that. But 4.5 is not under threat now. But here again, what they tell us about the global markets will be very important, because there's a severe deflation arising out of China as well. If you add to it a US slowdown, Chinese deflation has been there for some time now. You add to it the US slowdown, means the two largest economies are slowing. And the third largest economic bloc is Europe, which is already in a funk. So then they may give some indication. But I think they'll only say that there are these red flags in the global economy. I doubt they will, sound more dovish than that. And to be fair to the RBI, they have been ahead of the curve. Last year, or even by last year, earlier this year, calendar 24, the call rate was reigning above the repo rate. Now, what is the repo rate? 6.5%. What is the meaning for you and me? That is the rate at which banks borrow from one another for 24 hours. Today you ran out of money, I take it from you. That rate is 6.5. It used to be at 6.6, 6.7, because the interbank market was tight. Reserve Bank has, whatever it is, bought enough dollars. When you buy dollars, they print money and give it. So they're loosening the system. Or the government has spent a little more than it used to. So there is enough liquidity. Now liquidity is in balance. Banks are not borrowing too much from RBI. So the call rate has been at 6.5 or even less on a certain occasion. So that itself is a 25 basis rate cut, if you look at it from 6 months ago. So Reserve Bank has been ahead of the curve in terms of liquidity. They don't have to do any more.
Right. In terms of growth, I mean 7.2%. That's more than what the Eco Survey really predicted. So any tinkering here, or would they just leave it like that?
Not this early, I would assume. It's possible that if they see signs of global slowdown, they will, do something in the second half. Actually, in the October policy, there is something called the MPR that comes out.
Yeah.
The Monetary Policy Report. It comes out twice a year, April and October. So they could, via the MPR, signal that there is a slowdown, if there is. See, there is another aspect of the slowdown which I am hoping the Reserve Bank will address, and that is the fight for deposits.
That's what I was going to ask you next.
Sure, go ahead. What was on your mind?
The LCR norms that have come out, not come out, it's a draft, right? And if it passes muster, obviously banks will have to set aside more for those short-term volatile deposits. So in that sense, will there be something that you will be looking out for from the governor's post speech press conference? How how would that scenario play out for banks?
No, you put your finger on the on the spot that all bankers are watching. Bankers are actually what is this LCR? Because bankers take our deposits and give it as loans. Now suppose the deposits move very fast, and why are they moving fast? Because many of us are not saving in the form of term deposits. We are saving through mutual funds.
Yeah.
It's still in the banking system. All you have done is written a check from your savings account to the savings account of SBI MF or HDFC. It is still in the banking system. The SBI MF guy perhaps buys a share and transfers it to some brokerage. The brokerage sells that share. The point is it is short-term money.
Yeah.
And the Reserve Bank rule is that mobile money should be supported by a liquid instrument.
Yeah.
Because that person can come and take back the money in short notice. So you have to keep that much amount of, a 10%, actually 15, now it has become 15% of that mobile money in the form of high quality liquid assets, which is government bonds, which can be easily sold. So now that HQLA is rising, already bankers say we have put 27% of all our deposits there. 4.5% is CRR, which means
so can there be a CRR cut?
Now, CRR cut now makes no sense because the government is sitting on excess money of 4 lakh crore. That is what you call system surplus, liquidity surplus. And they will spend, on various projects. Now they have only 7 months for the year to end. They'll spend very quickly. So that liquidity will be available. And therefore, when so much, 4 lakh crore is lying, a CRR cut, there can be a good argument for a hike actually. So they won't cut now. But if the fight for deposits continues, then maybe there can be a time when suppose the Fed cuts by 50 and you still don't want to cut in October, then you can give that 0.5% CRR cut, maybe. I'm just like, this is highly speculative, but it is a liquidity issue, of a certain category only, not a liquidity issue for near-term money or anything. Banks don't have long-term money, which is a mix of several things. A lot of the money moved out during COVID when Reserve Bank brought down the rates to 4%. Many of people were aghast that they were earning only 3.5% and 4%. Now it takes time for the money that moved out to come back. It's a cycle. It's a 5-year cycle. So in good time, the deposits will come. I don't think the RBI will take structural decisions for such a thing.
Okay, so concluding this discussion, Latha ma'am, so it should be more about the talk and not about the walk, in your own language. So that's what, of course, we'll be watching out for. In terms of headline numbers, the RBI will stick to the script, but
it will be a largely status quoist policy on all the 4 parameters I told you: rate, stance, inflation forecast, GDP forecast. It is just that within this, are they sounding, when the governor spoke to me, that this is an inter-meeting interview we had, he was very clear, there is no chance of a stance change. There is no case for a stance change now. He was as emphatic as that. Now, I would call that a hawkish statement. He may not repeat that. Everybody is just wondering how will he communicate that maybe in October or December I'm going to change stance. Will that come in the first place? If that comes, where will it be hidden? That's what the market's going to watch out for. That's about the maximum you can expect.
Okay, then that's what we'll be watching out for. The walk. The talk. I'm sorry, not the
really
walk.
the talk.
It's the talk that will be in focus. Of course, we will be getting you live coverage of the governor's speech as well as a post-policy analysis with a battery of guests right here on Money Control. With that, Latha ma'am, I would like to thank you for taking out time and joining in, of course, and sharing your expectations from the governor. But, with that, we've come to the end of this live discussion. Thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates. And, of course, come back and join us at 3:30 on Closing Bell.